You're listening to the Financial Source Podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today we're doing a rapid-fire briefing, really connecting the dots between the global economy's biggest pressures.
Exactly. We're talking central banks, commodity shocks, these aggressive new tariffs.
And how they tie directly into the geopolitical flashpoints making headlines right now.
Yeah, our source material today is a focused global markets and geopolitical briefing. It's designed to, cut through the noise and just lay out the critical risks, how they intersect, because that's the key thing, the intersections.
Right. It's dense stuff, but the idea is for you, the listener, to see how maybe one small data point or one diplomatic spat can ripple across everything else almost instantly.
Exactly.
Okay, so let's unpack this. The mission really is to find those crucial connections. What's a central bank move telling us about a potential trade war?
Or how does a strike in, say, France suddenly become a global energy issue?
Precisely. We want to get beyond the headlines and understand the strategic thinking behind these actions. What are the key data points that impact your grasp of global stability?
And maybe the best place to start is often the financial backbone, right? Where confidence is tested. What are the currencies telling us?
Good starting point.
Yeah.
So the immediate focus, looking at the source, is the U.S. dollar. Its recent rally seems to be pausing a bit, holding its breath, you could say.
Ahead of the PCE data, right?
Exactly. That's the Personal Consumption Expenditures Index, the Fed's, preferred inflation gauge. Everyone's waiting.
Waiting to see if that number confirms prices are actually easing off a bit.
Mm-hmm. Meanwhile, you look across the Atlantic, the euro, well, it stayed pretty flat after the ECB's latest survey of consumer expectations came out.
Which is fascinating, actually, because even though the spot price didn't budge much,
yeah,
the inflation expectations in that survey of the 1-year and 5-year views, they actually edged higher.
So that sounds like a bit of market complacency, doesn't it? The currency is flat, but the people actually spending money, the consumers, they're signaling, hey, we think inflation might stick around longer term.
It keeps the pressure on the ECB, absolutely, because expectations themselves can fuel inflation,
Right.
Now, shifting over to Japan, we've seen the dollar-yen rate staying strong, kind of hovering near that big psychological 150 mark.
And the debate about what the Bank of Japan does next is still very much alive, right?
Yeah.
Especially since Tokyo CPI came in at 2.5% year on year.
Yeah, and while 2.5% was actually a bit softer than some expected, it was crucially unchanged from the month before.
So that really highlights the tightrope the BOJ is walking. How's the market reading that? That they won't move on rates or that they maybe can't afford not to?
Well, it suggests some real policy paralysis, maybe, but contrast that with China, the PBoC, the People's Bank of China. There we're seeing pretty active, decisive intervention.
Okay.
What's really interesting is the specific action they took. Amidst all these sensitive U.S.-China headlines, the PBoC set a stronger than expected daily fix for the yuan.
Okay, can you just quickly unpack that for listeners? What exactly is a stronger fix, and what message does that send?
Sure. So the fix is basically the central midpoint rate the government sets each morning for the currency to trade around.
Got it.
By setting it stronger than the market anticipated, they're essentially using some political capital, intervening to send a clear signal.
But yeah.
They intend to actively fight against any rapid slide in their currency. It's about anchoring stability, preventing capital flight, especially, as these trade tensions seem to be heating up again.
Okay, and we can see that direct link between finance, like the PBOC's move, and the physical economy when we look at commodity-linked currencies.
Right, like the Aussie and Kiwi dollars.
Yeah, the Australian and New Zealand dollars are holding steady, but the Aussie dollar's rally seems capped right now. And the reason? A pullback in copper prices. So if the AUD is stalling because of copper, maybe we should talk about the actual metal itself, what's happening on the ground.
Good transition. Yeah, if FX is the nerve center, commodities are kind of the muscles, right? And we are seeing some very specific, almost localized supply disruptions causing wider price swings.
Like that copper price drop we just mentioned.
Yeah.
The source material flags that had followed an earlier spike, and that spike was tied directly to supply issues out of Indonesia.
Specifically the Grasberg complex, Freeport's massive mine there.
Right. And production there has not yet resumed. It's just a stark reminder, isn't it? One critical mine offline can instantly ripple through global markets, affects everything from construction to, high-tech manufacturing.
Absolutely. And then in energy, the logistics side is getting tricky. We need to translate some jargon here.
Yeah.
There was a power sector strike in France, and that triggered what's called a force majeure at 3 French LNG terminals.
Right. And force majeure, just for listeners, that's basically legal out. It means they're declaring they can't meet their contractual obligations because of something unforeseeable, like this strike.
Exactly. So it effectively freezes a key entry point for liquefied natural gas into Europe, regardless of how high demand might be. And related to energy flows, look at crude oil. Iraq is apparently in active talks with Vitol, the big trading house, about how to handle crude sales going forward. And this is happening because they anticipate the Kurdish pipeline might restart soon.
So these are the real nuts and bolts pipelines, contracts, who's talking to who, that determine where oil actually moves and who gets it.
That's right, the physical side.
Okay, so it's clear these physical disruptions are causing, chaos. But the source material also suggests governments are now actively, maybe even deliberately, adding to the uncertainty with trade policy.
Yes.
Let's get into this new tariff package. It kicks in October 1st, and it looks like a really major aggressive shift aimed at boosting domestic production.
It's a policy tsunami, you could say. And maybe it helps to group these by their goal. First, you have the strategic tech tariffs. There's a plan being considered now to cut reliance on overseas semiconductors. How? By hitting companies with tariffs if they don't eventually maintain a 1-to-1 ratio of domestic versus foreign production.
So forcing companies to spread out their critical chip manufacturing geographically.
Pretty much. But then there's the really headline-grabbing part, the list hitting patented goods.
Yeah, I saw that. A massive 100% tariff on branded or patented pharmaceuticals, unless, that is, they're actually manufactured inside the U.S.
100%.
Why such a huge number, and why specifically patented goods?
Well, the thinking seems to be about strategic resilience. This huge tax targets the highest margin proprietary products.
Yeah, okay.
So it maximizes the financial pain, the pressure to reshore the production of really crucial, often unique medicines and technologies. It hits where the profit margin is biggest, making the cost of not building domestically almost unbearable.
That sounds like a potential game changer for how big pharma operates globally.
It really could be.
But it's interesting. This policy isn't just targeting those high-tech strategic sectors, is it? It also seems to hit everyday consumer goods. Feels like protecting domestic jobs, trying to reshore manufacturing that left years ago.
Exactly right. The list also includes things like 50% tariffs on kitchen cabinets and bathroom vanities.
Wow.
30% on upholstered furniture, and 25% on heavy trucks made outside the U.S. It's a very clear signal about protecting domestic industries.
It must introduce huge supply chain headaches, right? And potentially higher costs for consumers, at least in the short term.
Oh, absolutely. Huge uncertainty. It definitely pushes the U.S. much deeper into active industrial policy.
Okay, and meanwhile, tech policy quickly veers into national security, which brings us to TikTok.
Yep.
The executive order seems to have cleared a path for a U.S. ownership structure. But the key detail, the source says, is that American investors will control the algorithm. And Oracle's playing a big role there.
Right. And that directly tackles that core worry about data privacy and, maybe more importantly, algorithmic influence. Who controls what you see?
And are international partners reacting to all these new U.S. rules?
Oh, yeah, swiftly. Japan, for instance, put out a statement saying basically any U.S. chip or pharma tariffs applied to them shouldn't be higher than those applied to other countries. Sort of a treat us fairly plea.
Okay.
And Ankara, Turkey, has apparently been talking with Washington about trade facilitation, maybe revising some tariffs. Everyone's scrambling to adjust their strategies now that the U.S. is so focused on domestic production.
It makes sense. Okay, so tariffs seem to be about economic security, maybe deterrence, building domestic resilience. But the biggest risk to global stability, it often comes back to actual defense, doesn't it?
Usually does.
Let's look at how these financial and trade pressures might be translating into military readiness or tensions.
Yeah, and this is where things get really quite concerning, actually. The common thread, especially across Europe right now, seems to be the rise of these highly ambiguous threats. Think drones, airspace incursions.
Things that aren't easily attributable to a state actor?
Exactly, and that forces NATO countries to signal some pretty radical steps just to restore basic deterrence, basic security.
Okay, that helps explain the severity of these security warnings coming from NATO's eastern flank then. The source mentions European officials privately warned them they're prepared to shoot down aircraft after that recent incursion into Estonian airspace.
Yeah.
That's a massive step up in strategic messaging, isn't it?
Huge, unprecedented, really. And that kind of security concern is spreading. It's not just the border states. Paris apparently offered to help Denmark assess and secure its skies after they had a whole series of drone sightings recently.
So the drone threat is effective because it's murky. Who's launching them? How do you respond without accidentally escalating things?
Precisely. It complicates the whole deterrence picture.
Okay, turning to Ukraine. Washington seems to maintain that Kiev still has a shot at regaining territory. But, maybe more critically, the IAEA is reporting a drone actually detonated quite close, about 800 meters from the perimeter of Ukraine's South nuclear power plant.
After overnight UAV activity.
Yeah, it just highlights the terrifying reality of fighting a war near that kind of essential but incredibly volatile infrastructure.
Absolutely terrifying. And the war, of course, continues to ripple through global energy markets. The U.S. indicated it believes Turkey will halt its purchases of Russian oil.
Which would be a significant step in tightening sanctions enforcement.
It would. But the briefing also acknowledges, realistically, the immense challenge this poses for, say, landlocked EU countries that rely entirely on a single Russian pipeline. It shows how hard it is to enforce global sanctions without creating new problems elsewhere.
Right, the unintended consequences. Now, zooming into the Middle East. Wow, the diplomatic threads here are incredibly tangled.
Oh, he's complex.
On one hand, U.S. officials describe talks on Gaza as constructive, suggesting a hostage deal could be within reach. But at the same time, the U.S. is drawing a very clear line, stating Washington would not support any Israeli annexation of the West Bank. It's a major statement on a core sovereignty issue.
It is. And then you see these deeper strategic alliances playing out, too. Iranian and Russian officials announced this massive USD 25 billion deal to build 4 new nuclear power plants in Iran.
Wow.
And importantly, Iran then stated its cooperation with the IAEA, the nuclear watchdog, will continue as long as no hostile action like reimposing UN sanctions is taken against it.
So Tehran is explicitly using its compliance on nuclear inspections as leverage against international pressure.
Correctly. It's a bargaining chip.
And just quickly rounding out the region, Turkey is still trying to balance powers, discussing defense matters with the U.S., framing it as supporting peace in Gaza-Palestine.
Right.
And over in Asia, that old flashpoint remains active. South Korea reporting it fired warning shots at a North Korean commercial vessel that crossed the maritime border.
Never quiet for long there.
So, okay.
Yeah.
Stepping back, what does this all mean if we try to connect these pieces?
Well, if you look at the big picture, the data really shows central banks fighting these intense stability battles like the PBoC actively using its reserves, its capital, to prop up the yuan, while at the same time, Western governments are deploying really aggressive trade tools. That 100% pharma tariff is a prime example, trying to fundamentally reshape domestic production, reshape global supply chains.
Yeah, it really feels like the era of just relying on finely tuned, optimized global supply chains is, well, it's fundamentally over, isn't it?
It seems that way. And geopolitical risk isn't some abstract concept anymore. It involves literal incursions into sovereign airspace, drones buzzing near nuclear plants.
This deep dive, I think, really shows you, the listener, that market stability today isn't just about, whether the Fed hikes rates half a point.
Not at all.
It's intrinsically tied to things like who controls the algorithm on a social media app, where your kitchen cabinets or heavy trucks are manufactured, and whether Estonian airspace is secure.
It is. That interconnectedness means, like we discussed, a strike at an LNG terminal over in France can now genuinely impact the cost of manufacturing something halfway around the world.
It's truly astounding how linked everything is. So maybe the biggest question that comes out of all this information, the one we'll leave you to think about, is how quickly can these major multinational pharmaceutical companies, the ones squarely targeted by that new 100% tariff, how quickly can they really shift massive, complex manufacturing operations? And maybe more importantly, what does that timeline mean for the immediate availability and the cost of critical patented drugs for consumers everywhere?
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.